While the retail crowd is hyper-focused on Bitcoin hovering at $93,000, there is a massive divergence building in the derivatives market that almost nobody is talking about. Most people are staring at the price chart, hoping for a breakout. But the real story is currently happening in the order books and the liquidity heat maps. We are seeing a setup that we have not witnessed since the early stages of the 2021 bull run, and it specifically concerns how leverage is accumulating while spot volume drops off. If you are just watching the green and red candles, you're essentially flying blind into what could be one of the most volatile weekends of the year. The reality is much simpler than the noise on social media would have you believe, but it requires us to look under the hood at the mechanics of the market. Bitcoin sitting at $93,000 feels like a stalemate to the average observer, but to an institutional eye, this is a pressure cooker. Let us strip away the hype and look at the raw data to understand why this specific price level is acting as such a stubborn ceiling. The first thing we need to address is the concept of the weekend liquidity gap. During the week, we have the massive inflows from the exchange-traded funds, providing a constant bid and absorbing the selling pressure from miners and long-term holders. These exchange-traded funds have been the primary driver of this entire leg up, acting as a relentless vacuum for available supply. However, the moment the New York Stock Exchange closes on Friday afternoon, that structural bid disappears completely for 48 hours. This leaves the market in the hands of the offshore derivatives exchanges and the retail market, which changes the game entirely. When the institutional liquidity dries up for the weekend, the depth of the order book becomes significantly thinner. This means that it takes much less capital to move the price of Bitcoin 5% in either direction on a Saturday than it does on a Tuesday. This low liquidity environment is the perfect playground for market makers to hunt for liquidity. Right now, if we look at the liquidation heat maps, we can see a massive cluster of leveraged long positions stacked just below $90,000. These are traders who entered positions late, expecting an immediate breakout to $100,000, and they are currently overexposed. On the flip side, there is a wall of short liquidations sitting right above $95,000. Market makers are in the business of maximum pain, and in a low-volume weekend environment, they often push price toward these liquidity pools to force liquidations. This is why we often see what looks like a breakout or a breakdown on the weekend, only for it to completely retrace by the time Wall Street wakes up on Monday morning. It is not necessarily organic demand. It is often just a mechanical clearing of the leverage in the system. If this level of detailed breakdown is helping you navigate the noise and protect your capital, consider joining our community with a subscribe so you do not miss the next signal. Now, I want to draw your attention to a metric that is flashing a warning sign. We need to talk about the funding rates and open interest. Open interest refers to the total number of outstanding derivative contracts that have not been settled. Currently, open interest is hovering near all-time highs, which tells us there is an immense amount of leverage currently in the system. When open interest is this high, the market becomes incredibly sensitive to small price movements. A small drop can trigger a cascade of long liquidations, which forces more selling, driving the price down further in a domino effect. Conversely, a sharp move up can trigger a short squeeze. However, the funding rates, which is the fee that long traders pay to short traders, are starting to tick upward. This indicates that the majority of that leverage is biased toward the long side. The crowd is leaning heavily bullish, expecting the weekend pump to carry us to six figures. Usually, when the crowd all leans to one side of the boat, the market has a tendency to tip over in the opposite direction to flush them out. We saw a very similar structure in late 2020, right before we broke the $20,000 barrier. Back then, we spent weeks chopping around just below the all-time high, frustrating both the bulls and the bears. Everyone wanted the instant gratification of a breakout, But the market forced a period of consolidation to transfer coins from weak hands to strong hands. That is exactly what we are seeing right now at $93,000. Short-term traders are getting bored and selling, while longer-term entities are absorbing that supply. We can see this in the on-chain data regarding exchange outflows. Despite the price stalling, Bitcoin is continuing to leave exchanges at a rapid pace. This is a supply shock in slow motion. The available supply of Bitcoin on exchanges is reaching multi-year lows. This creates a scenario where, once the leverage is flushed out, the price can move upward with very little resistance because there are simply no sellers left. But before that happens, we have to navigate the weekend chop. Another factor we must consider is the psychological barrier of the $100,000 mark. Humans are obsessed with round numbers. The sell wall at $100,000 is likely massive, not just because of technical analysis, but because of human psychology. People have had sell orders set at that level for years. The market rarely gives everyone exactly what they want on the first try. It is highly probable that we will see a fake out or a rejection before we cleanly break through that level. So, what is the playbook for this weekend and the coming week? We need to look at two distinct scenarios and prepare for both. Scenario A is the liquidity flush to the downside. In this scenario, the market makers use the thin weekend liquidity to push the price down to test the $88,000 to $90,000 region. This would trigger the stop losses of the late longs and reset the funding rates. If you are a spot buyer, this is not a reason to panic. It is a buying opportunity. This would be a healthy correction that removes the froth from the market and sets us up for a more sustainable move higher next week when the institutional flows return. If we see a wick down to $88,000 that is quickly bought up, that is a classic bullish confirmation. Scenario B is the structural breakout. This would involve Bitcoin pushing through $95,000 on high volume and holding that level as support. However, for this to be a valid breakout, we need to see spot volume leading the way, not just derivatives volume. If the price pushes up but the volume is low, it is likely a trap. You want to see the Coinbase premium turn positive. The Coinbase premium measures the difference in price between Bitcoin on Coinbase and Bitcoin on Binance. When the premium is positive, it means American institutions and high net worth individuals are buying aggressively. If the price goes up, but the Coinbase premium is negative, it means the move is being driven by offshore speculation, and those moves rarely sustain themselves. Currently, the premium is neutral, suggesting the big players are waiting for a clear signal. Another critical data point to watch is the dominance of Bitcoin relative to the rest of the market. Bitcoin dominance has been climbing, sucking the liquidity out of the altcoin market. This is typical behavior before a major leg up. Bitcoin usually leads the charge, breaking new highs first, and then the capital rotates into Ethereum and other assets later. Trying to chase altcoins right now, while Bitcoin is at this critical resistance, is a dangerous game. The risk-reward ratio favors sticking to the king until the breakout is confirmed. We also need to keep an eye on the macroeconomic calendar for next week. While the weekend is isolated, the market is forward-looking. Traders are already positioning themselves for upcoming inflation data and central bank speeches. Any hint that inflation is sticking around could strengthen the dollar, which acts as a headwind for crypto assets. However, the correlation between Bitcoin and traditional finance has been weakening recently. Bitcoin is starting to trade more like a distinct asset class rather than just a high beta tech stock. This decoupling is a very bullish long-term signal, but in the short term, liquidity is still king. The key takeaway here is patience. Most traders lose money not because they are wrong about the direction, but because they are wrong about the timing. They use too much leverage and get shaken out by the volatility at these key levels. The smart money is sitting on their hands right now, waiting for the market to reveal its hand. They are not trying to guess the next hourly candle. They are looking at the weekly close. If we can close the week above $93,000, it sends a very strong signal for the week ahead.
But if we close weak, we could be looking at a retest of lower support levels to gather more energy. Remember that a market that cannot go down eventually must go up. We have absorbed so much bad news and so much selling pressure, and yet we are still sitting within striking distance of all-time highs. That resilience is the most important signal of all. The sellers are running out of ammunition. Every dip is being bought up faster and faster. The time to be bearish was at the bottom of the cycle, not when we are knocking on the door of price discovery. However, managing your risk is paramount. Do not get leveraged to the hilt expecting a straight line up. The market is designed to transfer wealth from the impatient to the patient. Watch the funding rates, watch the Coinbase premium, and watch the weekend volume. If the volume completely disappears, expect a fake out. If the volume spikes, follow the trend. It is really that simple when you filter out the noise. We are in a historic window of opportunity, but it requires discipline to navigate correctly. If you found value in this deep dive, a like helps the algorithm share this data with more serious investors who need to hear this message. Nothing mentioned here is financial advice. Markets are risky, and you should always do your own research and consult with a qualified professional before making any investment decisions.